Thank you, Susie, and thank you, everybody, for the opportunity to talk to you at this point in time. As Susie said, I'm Clive Webb from the ACCA. I'm part of a group called Business Management, and that's the research part of ACCA, and in particular, my lens is around the finance function, but also the diversity and inclusion agenda. So in this session, we wanted to look at this very much from a CFO angle, picking up on that 20% that we saw a few months ago. And I'm delighted to have Alex and Thomas and Ian with me to talk this through for about the next 20 minutes or so. So Thomas, if I can probably start with you. We've heard quite a lot of phrases that I closely associate with the role of the CFO, of trust, of data, of reporting, of integrated reporting, of taking the wider view. How much of this, in your view, is actually part of the expanding role of the CFO? We know the CFO role is not just financial now. So how does this fit in very much with your view of the broader agenda of the CFO role?
Yeah, no, that's very, I just wanted to pick up on the point that Mike mentioned the last about particularly like employment's been an investment. Traditionally, finance has seen employees just being as expense, but I come from a tech background, and given the fact that recruiting is so difficult and a lot of time and effort is put into hiring people, I was glad to hear that someone else is seeing them as an investment, not just as purely as a cost. To be honest, I think the role of the CFO is very much changing as well. I mean, risk management and so forth has always been part of the role of the CFO. Let's face it. At the start of my career, I mean, we had things like Y2K was a big issue. This year, we've had global health pandemic risk, which we haven't seen since 1919. Political risk. I mean, every time we have an election here in the US, there's always something. So I think having ESG, it's just a logical next step. Also in terms of, I mean, the CFO being part of that. And I think it's important for the CFO being part of that as well, given the fact that they're one of the few functions that actually work with people on a daily basis across the organization. We also control the purse strings, so that makes us a very influential person within the organization as well.
So is this part of this transition that we're seeing of the CFO role to being something more akin to a chief performance officer, a chief value officer, and all of that fits under very much this umbrella, but also the relationship between the CFO and the CEO as being the dynamic drivers of this agenda and the broader agenda for organizations?
Yeah, I believe it is, because for a large extent, I mean, the CEO and the CFO and maybe the COO as well are very much the three key tripartite, if you want to, leaders within the company. And I think it's key for them. They are usually the people who are presenting directly to the board. They're the people who have the exposure. So having them as the people who are the owners, the champions for ESG, it is very critical. And to do that, you really need to understand it. I mean, really, what is ESG then? And from my perspective, I look at it in three areas. I take what they call the triple bottom line approach, which is looking at the financials, looking at the social aspect, and looking at the environmental. Or best way of putting it is the three Ps: profit, planet, and profit, planet. Sorry, my third one is my profit, my planet, and my
purpose,
and my people, so there's the way I think we look at it, and I think. I mean, boards and CFOs and CEOs don't live in a bubble. I mean, we know what's going on in the real world. We know what people are looking for, and I think we have to be the champions to make that change and really be the advocates within the company. So it's, again, I mean, I think as people on the last call, it's common sense. I mean, you want to maximize your bottom line, but not. I mean, profit in itself is the immediate one, but also long-term company value. How do you build long-term company value? Being efficient, having the people to execute on your strategy. All those are impacted by a strong ESG strategy.
That takes us nicely, I think, to Alex, if I may. So Tom just mentioned there that the concept of value and value creation, and how we need to perhaps relate that, as we've heard earlier on, to the use of analytics, taking the broad view, but also taking the predictive view. What's your view on that, and how does that relate to the organizational success that Thomas just talked about?
So thanks, Clive. It relates very closely to what Donato was saying in the previous session about the need to think about the carrot as well as the stick, because it's very easy to talk about ESG in using the language of risk, and it would be very easy to put that with the CFO because of being the member of the C-suite that's principally responsible for risk. But to take that approach to an ESG response, and I'm deliberately avoiding using the word compliance, is dangerous because it misses the constructive opportunity represented by the challenge of ESG. And I think that if you do manage it from a risk perspective only, you can get into a very defensive position, and a position which is not likely to generate alpha, and which is like to take refuge in protocols and processes and compliance statements, which is certainly not what the investment community wants. And I don't believe it's what society at large wants. And I don't think that that will potentiate the social, the human capital, as well as the climate capital which businesses have available to them. Drawing a net around all of that, the constructive response does depend upon some of the concepts which have been discussed earlier, which are now, thank God, becoming trite, which is the need for businesses to develop a bespoke ESG strategy, and that strategy has to have materiality at its heart, and that in working out what's material, businesses need to think about strategic materiality rather than just operational materiality. And having identified that strategic materiality, they then need to operationalize it. If you do that manually, it takes a very long time. The digital revolution means that that whole process is vastly accelerated. We should be conscious, by the way, of the fact that the digital revolution does have two sides to it. It is a two-edged sword. It does represent a challenge as well as an opportunity, because the power that it puts in the hands of boards and in the hands of CFOs, it also puts in the hands of boards of litigators and of litigation funders. So it does mean that the board of any business has a very powerful tool in its hands, which can be used against it as well as for. I think it emphasizes the importance of authenticity, which again is an easy word to trot out, but authenticity as an agenda item can only be realized if you start with high quality information. And getting access to that high quality information is again vastly enabled by having access to the data pools that we now have available to us, which Tanze was talking about earlier in the context of proving positive financial output from effective ESG behavior. And if you take that data and you link it to the possibilities represented by augmented intelligence, you are into a different universe of priority and a different power in the hands of the CFO and the CFO's team to evaluate the business's potential response to that. So yeah, it's there's a convergence here. But I guess the most important thing to start with is to make sure that your whole board, not just the CFO, has crossed that Rubicon, because we saw an awful lot of evidence that was pulled together in 2020. At the end of 2020, we saw this extraordinary phenomenon of widespread awareness of the ESG imperative, but a remarkable inaction. And the inaction wasn't based on, I think, a lack of willingness to engage. It was the lack of knowledge as to how to go about doing it.
So that's a call for education, really, isn't it? And events like this to help people really understand.
Absolutely. You have to have that understanding, and you have to have that willingness to take the next step. We see an awful lot. I don't dispute the volume of ESG disclosure that we're seeing in the market, but I worry greatly about the authenticity of that disclosure. And I don't mean by saying that, I must be absolutely clear, I'm not suggesting that any of that or very much of it is backed by an intention to misrepresent the position. I think that sometimes it's an innocent and bona fide attempt to try and deal with what's seen as a compliance challenge, which produces a volume of so-called ESG disclosure, which lacks that authenticity. It lacks that core strength that is so important to generating the alpha that everybody is seeking from this.
And that probably nicely takes us on to a discussion about data, because you can only report what you know, but also data itself in this agenda is a far broader subject, and CFOs in particular are honing in always on this one version of the truth and the one version of accuracy. And Ian, if I can probably bring you in here, we've heard before about unstructured data, about social media data, and bring on to Alex's last point as well about conveying the message. How do we get people to think broader about data and the veracity of data and trusting that data?
Thanks, Clive. You know, I would like to just firstly echo the changing role of the CFO, and I think that they have historically been the champions of innovation within companies. So if we consider that innovation and the role of technological change, the change of data and data availability, then they are rightly the person at the helm to be able to capture that and capitalize on it and understand how to embed that for better business decisions. So, you know, I think with our collaboration with ACCA and the accountancy space, I think accountability is a word that comes up and to the front of mind for me. And that also relates to being able to understand that value creation, where you have value creation and where there's value at risk. All of this is predicated upon having business useful data that can help you to identify, pinpoint that, and make decisions on it. You also need to consider how that value at risk is being measured, and ensuring that you are staying ahead of the curve as related to the white rhino story that we heard before. You know, if you are at the helm considering the risks that could occur as you push your company to achieve more, as you consider the wider capital impacts that you're having and the value creation there, then, you know, I think that that technology and data play a critical role in being able to realize that. And finally, I would just say, you know, considering the transparency element, that is also a critical piece of the conversation that we're having today. You know, it's up to the CFO to understand, as Alex and Tansi mentioned before, you know, what are the financial implications of the ESG programs that you have in place, and how do you report those transparently to your variety of stakeholders? And you know, I think that's another key facet of this changing paradigm.
And Tom, that stakeholder net is getting bigger, isn't it? And it's not purely a financial data stakeholder net anymore.
No, that's certainly true. I mean, when you have stakeholders, especially I'm from the tech business. I mean, you have flat organizations. You're invested not alone with your investors. You're invested with your clients. You're invested with your employees, and you're invested with the community in general. I mean, there has been a lot of corporate advocacy, especially in the last 6 months, and that is only going to be continue as well. One of the things I think that Ian mentioned there was accountability, and it's interesting. Over the last year, everybody, up to about 2 years ago, everybody was talking about D&E, diversity and inclusion. In the last 2 years, you've seen very much a move towards ID, which is IDEA, inclusiveness, diversity, equity, and accountability. So I think that is going to be a very big issue going forward. And again, as you said, accountability is not just for investors, it's to everybody, really the broader stakeholders in the company as well.
And Alex, that probably builds us out into one of the other attributes of the CFO, the acquisition, the disposal. And how do you see this ESG agenda really building into the due diligence process that really feeds that? Because that's also another key aspect of the CFO's domain, especially in this post-pandemic world where we're seeing a lot more fluidity in that market.
Well, I think in response to that, Clive, there is the business as usual dimension of any business has to be mined and understood by the board in order to map any business's ESG DNA. But it may be that you would find that there are shortcomings that can't be handled organically, they can't be addressed organically and they need to be handled by some sort of corporate event, either an acquisition or a disposal, and the financing of an acquisition or any other type of corporate activity. And the use of, I mean, of course, all of those processes involve due diligence exercises, and I'm sure most people on this call have had some contact with that at one stage or another. And the old style of doing those was more or less effective. The emphasis over the last 10 to 15 years has been recognizing, and this is not just an issue for the legal profession, but it is an issue for the legal profession, that producing diligence reports that are measured in tens of kilos doesn't mean that they're better quality or more helpful than a shorter version. But you have to be brave in order to shorten things because of the litigation environment in which we operate. If something isn't there, the assumption is it hasn't been addressed and therefore it can be sued upon as missing. So, you know, that has to be sorted out. But the impact of digitalization and the use of AI in order to augment due diligence exercises means that we have the ability to get a far greater insight into the challenges and the value of targets, and indeed the value of businesses that we want to dispose of. And that puts the field of corporate activity and the deriving of appropriate prices for that activity in a different perspective. And it should mean that M&A as a value realization tool in an ESG environment is much more effective than it has been in the past. People have often criticized M&A to say, actually, as a value generation tool on its own, it's not great, often because people neglect the embedding process that they have to go in after they've bought or sold something. But, you know, couple that together with digital, enhance it with AI, and you've got a different universe.
But particularly that integration piece, and you're right, a lot of value is not created in the way that people claim it should be created because of a failure to integrate. That creation piece, that integration piece is absolutely fundamental. But across the ESG agenda, probably there are more challenges than there are in the integrated finance function, the back office, or a sales function.
Yes, I mean, a number of the concepts are more subtle and are more unfamiliar to us. But as we get further along the ESG journey, and incidentally, one of those aspects of the journey, which I think is it's conceptual at the moment, but it is very exciting as a next big thing. We've talked about the putting of the ESG responsibility on the CFO's desk because it's kind of a natural extension of what the CFO does anyway. There is a possibility, a real possibility, that ESG performance can be financialized. So, and you know that the Big Four are leading some very interesting projects in relation to this, where a business's ESG performance can actually be expressed in dollars or pound shillings, and it can be articulated in a GAAP or IFRS type fashion. That is not with us at the moment, but when that happens, it will bring the CFO's regime more closely into alignment with what a business's ESG performance looks like. And I think then we will see this greater familiarity of the input and the output. But what you're saying at the moment, Clive, is absolutely spot on, that actually manipulating those metrics and the understanding of those metrics, it's less, it's an area with which we're less familiar at the moment. That's something that has to develop.
And Thomas, maybe if I just bring you back in to conclude us off, this is why it matters to the CFO, effectively.
Yeah, I mean, it does. I mean, that's the bottom line. I mean, the role of the CFO is to help out the CEO, help maximize the value of the company. I mean, the approach I like to take, as I mentioned, was a triple bottom line approach. It's not a coincidence. Companies like Lego, companies like Starbucks, Mars, all use the triple bottom line approach, and they come back as some of the companies most admired, companies that most people want to work for. So, I mean, I think it is an important thing, and I think to Alex's point on making it a tangible thing, it is key, and it can be measured. My last company I was with, we measured diversity and inclusion. We measured gender pay gaps. These are all great retention tools when you share with your employees and investors. They show that you truly care. And as I say, I'm from an IT background. Hiring IT talent is always a challenge. It was something that sets us apart from other companies. We can't pay as much as the Googles or the Facebooks, but we truly have an actionable diversity policy. For example, every year we used to give an employee half a day out of billable time in a consulting environment to go work on equity, diversity, and inclusion projects. So, I mean, I think as companies truly put their dollars where their talk is, I think we are going to see more. And the return is huge. And I think we're at an exciting time particularly from a CFO, and I think it's CFO being generally associated with the numeric skills, the data-driven skills. I think CFOs in the future are going to have to develop more of those softer skills. And really, when you're looking at balance sheets, the role of the value of that will be coming through, and particularly in terms of the value of companies in the more intangible way than we have seen in the past. But it definitely has a very strong value.
And thank you, Thomas. And I think that's why we start to talk about Chief Value Officer and the Chief Performance Officer as synonyms for the CFO. And I think we hand back to Suzanne.
Brilliant. Thank you, Clive. Thank you, Alex. Thank you, Tom and Ian. Definitely a lot of key takeaways that were summarized in that conversation, and ultimately, who's responsible for overseeing these types of risks and opportunities when it comes to really integrating that into core business, annual reporting, and board oversight. So we're going to be busy getting all of these key takeaways wrapped up and shared with you. But before we close up the event, I want to bring it back to Alistair and Mariella, who have been listening and kick this off, and hear from you. What's really stuck with you from this conversation? What are some of the takeaways or calls to action that you have for everyone in the audience?